Hey Fed watchers, and welcome back to Fed Speak. Today, we're diving deep into a topic that's absolutely crucial for understanding global finance and your portfolio, the enduring and some might say unshakable international role of the US dollar. We've got a brand new Fed's note that breaks down exactly where the dollar stands in 2025, and let me tell you, the picture is fascinating. Is the dollar still king? What are the latest trends? And most importantly, what does this mean for you as an investor? Stick around because we're about to find out. All right, let's get right into the details from the latest Fed's notes, an updated look at the international role of the US dollar. For a century, the dollar's dominance has been built on the back of a strong U.S. economy, openness to trade and capital, and solid property rights and the rule of law. This has led to deep, liquid U.S. financial markets and an unmatched supply of safe dollar-denominated assets. Now, the report acknowledges a recent uptick in policy uncertainty and questions about U.S. economic stability, especially following Moody's downgrade of U.S. government debt and increased tariffs. However, the data we have now is a baseline from before these events fully play out. First up, let's look at the overall international role of the dollar versus the size of the U.S. economy. As Figure 1 shows, in 2024, the dollar's international usage, as measured by an index combining various factors, is little changed over the past 5 years. Crucially, it far exceeds the U.S. share of global GDP and trade. The dollar is even dominant in financial innovation like stablecoins. Now, let's talk about confidence as a store of value. Official foreign exchange reserves are a key indicator here. In 2024, the US dollar comprised a massive 58% of disclosed global official foreign reserves. That's way more than the euro at 20%, the Japanese yen at 6%, the British pound at 5%, and the Chinese renminbi at just 2%. While the dollar's share has declined from its 2001 peak of 72%, it's actually returned to the share it held in 1995 and has been basically unchanged since 2022. This suggests that sanctions on Russia haven't triggered a significant fear-driven reallocation away from dollar reserves. Central banks can also hold gold as an alternative. Figure 3 shows the share of gold in official reserve assets has more than doubled since 2015, reaching over 23%. However, this is largely due to a more than 200% increase in the gold price, not a significant increase in the physical quantity of gold held. And importantly, increases in gold holdings aren't generally associated with a decline in US dollar reserves, except for a few specific countries like China, Russia, and Turkey. The bulk of those dollar reserves, they're held in U.S. Treasury securities. As of Q1 2025, foreign investors, both official and private, held $9 trillion, or 32% of marketable Treasury securities. While this foreign share has declined from nearly 50% in 2014, it's been little changed since 2022, and is comparable to foreign holdings of debt in the Eurozone, Japan, and the UK. It's not just Treasury bonds. Foreigners also hold a staggering amount of US dollar banknotes. Figure 5 shows that the value of dollar banknotes held abroad has increased over the past 2 decades, both absolutely and as a fraction of total banknotes outstanding. Over $1 trillion in dollar banknotes were held abroad in Q1 2025, about half of the total. The growth here has slowed in the last 2 years, likely due to higher U.S. interest rates making non-interest-bearing banknotes less attractive. Interestingly, the rise of stablecoins, anchored to the dollar, is also noted as a potential alternative to dollar banknotes in some developing countries. By April 2025, the total market cap of dollar stablecoins hit around $220 billion. Many countries also use the dollar as an anchor currency, limiting their own currency's movements against it. The report estimates that over half of countries in 2019 had their currency anchored to the dollar, and this is unlikely to have changed significantly. Moving to its role as a medium of exchange, the dollar remains dominant in global trade. Figure 7 illustrates the share of export invoicing, showing the dollar's overwhelming use. For the Americas, it's 96%. Asia-Pacific 74%, and the rest of the world 79%. Europe is the exception, with the euro dominant at 66%. While time series data for trade invoicing is scarce, SWIFT international payments data in Figure 8 shows the dollar holding about 50% of the market, even slightly increasing recently. If you include intra-euro area payments, the dollar share jumps to 60%. This dominance extends to international banking, as shown in Figure 9. About 55% of international claims and 60% of liabilities are denominated in dollars. These figures have been stable since 2000, significantly higher than the euro's 20%. Similarly, in foreign currency debt issuance, the dollar has held around 60% since 2010, far outpacing the euro's 26%. The sheer volume of dollar transactions is also evident in the FX market. Figure 11 shows the US dollar was bought or sold in about 88% of global FX transactions in April 2022, a share stable for 2 decades. The euro, by contrast, was involved in 31% of transactions, down from its 2010 peak. Overall, this report constructs an aggregate index of international currency usage, combining reserves, FX volume, foreign debt, cross-border deposits, and loans. As seen in Figure 12, this dollar index has been remarkably stable, staying between 65 and 70 since 2010, far ahead of the euro at around 24. Other currencies like the renminbi are only at an index level of about 3. Finally, central bank facilities play a role in supporting the dollar's global status. The Federal Reserve swap lines and the FEMA repo facility provide crucial dollar liquidity during crises. Figure 13a shows how extensively these swap lines were used during the 2008-2009 financial crisis, $558 billion, and the COVID-19 crisis, $450 billion. The lack of usage in non-dollar swap lines, shown in Figure 13b, highlights how critical dollar funding is for international banks. So, while the report discusses potential long-term challenges like increased European integration or China's growth, it concludes that near-term challenges appear limited. Geopolitical adversaries don't have many attractive alternatives to dollar-denominated assets, especially since key reserve currencies are issued by U.S. allies. While China's economy is growing, roadblocks like currency inconvertibility and capital account restrictions limit the renminbi's international use. And even digital currencies, while growing, mostly operate in dollars, potentially reinforcing dollarization. The report's overall takeaway? Absent large-scale disruptions that damage the dollar's value and simultaneously boost alternatives, the dollar is likely to remain the world's dominant international currency. All right, so what does all this mean for us as investors? Look, the headline here is clear: stability and dominance. Despite recent news about credit rating downgrades or tariffs, the fundamental, deep-seated reliance on the US dollar globally remains incredibly strong. For me, this reinforces the dollar's role as a bedrock asset. When the world needs a safe store of value, a reliable medium of exchange, or a stable anchor for its own currency, they still overwhelmingly turn to the dollar. This isn't just about the U.S. economy. It's about the depth and liquidity of its financial markets and the perception of safety and stability, even amidst headwinds. The fact that the dollar's international usage index has been so stable for so long and its share in reserves and payments remains so high tells me that a rapid dethroning of the dollar is unlikely. While we see diversification into other currencies and gold, the dollar's infrastructure and network effects are just too powerful. So, what's the impact on investors? It means that dollar-denominated assets, particularly U.S. Treasuries and well-established U.S. companies, continue to benefit from this global demand. It also suggests that holding dollars, or dollar-pegged assets, provides a relatively safe haven in an uncertain global economic landscape. For those looking for international diversification, while other currencies have their strengths, the dollar remains the default for many, which can create tailwinds for dollar-based investments. Based on this report, I'm not making any drastic portfolio overhauls, but it does reinforce my current strategy. I'm leaning into the stability the dollar provides. Firstly, I'll continue to maintain a significant allocation to U.S. Treasury securities. The data showing their continued demand by foreign investors, even with recent policy shifts, gives me confidence in their role as a safe, liquid asset. Secondly, I'm not going to underestimate the power of dollar-denominated businesses. Companies that export heavily or have global operations benefit from the dollar's strength and its widespread use in international trade and finance. This report validates that trend. Thirdly, regarding foreign currency exposure, I'll remain cautious. While diversification is important, the report highlights the continued challenges for other currencies, like the euro and renminbi, to truly challenge the dollar. This means I'll likely stick with my current allocations to other major currencies, rather than making a significant pivot based on potential but uncertain shifts in currency dominance. And finally, the mention of stablecoins as a potential alternative, but largely dollar-backed, reinforces my view that digital innovation in finance is more likely to entrench the dollar's dominance rather than diminish it, at least for the foreseeable future. So, for my own holdings, I'm thinking about how I can strategically use dollar-denominated digital assets, or investments that might benefit from increased dollarization, rather than viewing them as a direct threat to the dollar itself. That's all the time we have for today on FedSpeak. This is not financial advice. All opinions are for informational and entertainment purposes only. Please consult a professional for your financial decisions. Don't forget to like, subscribe, and hit that notification bell so you don't miss our next deep dive. Until then, stay informed, stay invested.